there's a certain fascination that comes from purchasing goods and services. Maybe it's a sense of power that you, a mere mortal, could pick something up and it hereby belongs to you. Industries have been built when people realized that power could be wielded to make profits. And people felt even more powerful when they could purchase goods and not pay money for them. That's probably why credit cards became one of the most preferred methods for payment in India. Companies and startups began to flood the market with credit card and interest-free credit schemes. We became hooked on to that feeling, and boom, it was a success. People seemed to love the light touch experience where transactions could be handled with maximum ease and minimum obstacles. And in the course of the pandemic, e-commerce use and digital payments snowballed in the face of a changing consumer landscape and a change in attitude towards spending. But credit cards were cumbersome in the form of credit score mandates, being time consuming, having paperwork and more. And then came a clever new idea, BNPL, buy now, pay later. So how does it work? It's exactly as the name says. First, you sign up for a company that provides a BNPL facility. Then you make a purchase like a phone without paying from your pocket when you buy something. Let's say the cost of the phone is 10,000 bucks. The lender company pays on your behalf. You may have to make a small down payment. You as a buyer have to repay that 10,000 bucks within a fixed period of time, say like 1 month. You would either pay it as a lump sum amount or you can go the EMI route, and there is no interest levied. Let's say you don't repay the money in 1 month. The lender is not too happy about it and they would charge you interest on your amount. Delay even further and your credit score gets hit. You may not be allowed to use the BNPL facility after that if the amount is not paid back in time. Even if you may be somehow allowed, the interest rate would be even higher next time. And are these BNPL ventures successful? Well, Australian startup Scalapay rocketed to unicorn status with the $852 million raised in February 2022. French BNPL startup Alma raised $200 million in February 2022 as well. And back home, Indian fintech Slice, which offers BNPL, turned unicorn in November 2021 with $220 million in funding. So consumers are buying now and paying late. Even Visa and MasterCard announced their own BNPL initiatives in 2021, while Apple launched a BNPL service through Apple Pay. All in all, BNPL is short-term financing to provide liquidity. Patience levels may be dipping for the younger generation when it comes to traditional paperwork. People want more transparency, accessibility and flexibility, and BNPL can step up to deal with these friction points. It got more stickiness owing to the convenience. In 2021, the BNPL sector raised over $525 million in India, according to Statista. And yet, there's a tiny hair in the soup. With great power comes great responsibility. With amassing popularity comes a swath of risks. One study estimates that losses from online payment fraud between 2021 and 2025 may amount to $206 billion. Spending on fraud detection and prevention services may exceed $11.8 billion globally in 2025. BNPL may be a shadow economy for lending with regulations not exactly in place to maintain guardrails. And if you are lending money to numerous customers who may not be able to repay their loans, they may create a bubble that may upend financial markets. If there may be a crunch, debt providers like BNPL may end up being rattled. Think about the 2008 subprime crisis that collapsed the US economy and created a harmful ripple effect, making many people homeless and jobless. Banks, financial institutions, and hedge funds had some sketchy deals and mortgages were given out without any due diligence. Anyone with a terrible credit score could get approval for a loan. Then the rate of federal funds increased, adjustable mortgage interest rates skyrocketed, and people ended up defaulting on their loans. Sound familiar? BNPL startups may provide flexibility, convenience and interest-free credit, but there isn't really a regulatory framework in place. That means these providers do not have to employ affordability checks when it comes to consumers, with consumers ending up with accumulated debt across many lenders. There are late fees and there may be debt collectors involved if payments were missed, and when there is inflation, a looming recession and geopolitical crisis, will people be able to make those payments? But whether regulation could stop a bubble from expanding is another debate altogether. If affordability checks are implemented and overspending is associated with strong credit risk, will consumers stop using BNPL? Now, that's a great question to be asked. Will its consumption be reduced? Would customer disregard the flexibility it provides? The credit card industry is regulated more now. Has credit card debt been reduced? Fintechs need to exercise due diligence while onboarding new customers. Consumers may be spending more on non-essential purchases and they may be spiraling consumer debt. To be fair, removing the asymmetry of information between companies and consumers to help them understand the impulsive spending and debt traps may not necessarily be their long-term priority. But it would go a long way to nipping a potential bubble in the bud and help them understand their spending patterns. There may be stormy weather ahead, so it may be time to make one boast resilient. So, would you use BNPL?